All right, welcome future chartered market technicians. Today, we are going to tackle a concept that you absolutely must master for your Level 1 exams, and that's the foundational principles of Dow Theory. So let's get right into it.
So here's our game plan. We're going to start with the world that created the theory. Then we'll get into its core mechanics. The two averages and that all-important principle of confirmation. And we'll wrap up with why this idea, which is well over 100 years old, is still a cornerstone of technical analysis today.
To really get Dow theory, we have to kind of travel back in time. We need to understand the problem that Charles Dow was trying to solve in an America that was industrializing at an incredible pace. So picture this. It's the late 1800s. The Transcontinental Railroad just connected the country, and the U.S. economy is just exploding. And you have Charles Dow, the editor of the Wall Street Journal, who desperately needs a way to take the temperature of this whole economic boom. So his first step, back in '84, was pretty logical. He started tracking the biggest industry out there, the railroads. But he figured out pretty fast that that was only one piece of a much, much bigger puzzle.
This was really the fundamental question he was facing. You got to remember, there weren't a ton of economists back then. So Dow turned to the stock market itself. He saw it as the ultimate judge, believing it held all the clues to where the economy was headed. And this led him to a really brilliant insight about how the economy actually works.
Dow realized that just tracking the shippers, the railroads, it just wasn't enough. It's like watching the trucks on the highway but not knowing what they're carrying. You had to track what they were shipping. You needed to see both sides of the economic coin, the production and the distribution.
Dow's logic here was simple, but honestly, it was profound. I mean, if companies are making more goods, that's the industrials, than the companies that ship those goods, the transports, they must be doing well too, right? He saw them as two gears in the same economic machine. For the economy to be truly healthy, both of those gears had to be turning in the same direction.
Now here's an important little historical note for your studies. Charles Dow never actually called his work Dow Theory. He passed away in 1902. It was actually his successors and other writers, people like S.A. Nelson and William Peter Hamilton, who took his editorials and organized them into the formal theory that we study today.
Okay, so let's get into the actual rules of the theory. These are the foundational ideas, and you really need to know these cold for your exam. So think of these as the pillars. First, the market discounts everything. It's always looking ahead. Second, you have to use both averages, the producers and the shippers. Third, you only use closing prices. Dow saw the close as the final verdict for the day. And last, but most importantly, the two averages have to confirm each other. This principle of confirmation, it is the absolute key to this whole thing. Let's really focus on this one concept now, because it's not just the bedrock of Dow theory. It's the foundation for so much of the technical analysis that came after it. Understanding this is completely non-negotiable.
You should probably commit this definition to memory. See, confirmation isn't just about prices moving in the same direction. It's about both averages decisively closing above a previous high or below a previous low together. It's this harmony between the producers and the shippers that validates a new primary trend.
So, what does this look like in the real world? Well, for a bull trend to be confirmed, it's a two-step process. First, the industrials have to break out, closing above a key prior peak. Then, the transports have to do the same thing. When both of them have done it, then, and only then, is the primary bull trend considered confirmed.
And the logic is exactly the same for a downtrend, just flipped upside down. The industrials must close below a significant previous low, a support level. And then, the transports have to follow along and break their own corresponding support. Only when both have broken down is the primary bear trend confirmed.
Now here's a critical little detail. The confirmation doesn't have to happen on the exact same day. A little bit of a lag is okay. But, and this is a big but, when one average makes a new high and the other one fails to follow it, that's called a non-confirmation or a divergence. And that is a major, major red flag. It's a sign that the primary trend is probably in trouble. Dow also noticed that the market doesn't move in a straight line. He came up with this really powerful analogy of the ocean to explain that there are three distinct movements happening all at once. You have the primary trend, which is like the tide. You have the secondary trend, which are the waves, and the minor trend, which are the little daily ripples.
And this chart gives you a sense of the time frames. The primary trend, that's the tide, is the major bull or bear market that can last a year or more. The secondary trend, the waves, are those significant corrections against the primary trend, and they can last a few weeks to a few months. The minor trend is just the daily noise. For a true Dow theorist, the only thing that really matters is figuring out which way the primary tide is flowing.
And that brings us to another key point, volume. You can think of volume as a second layer of confirmation. In a healthy uptrend, volume should get bigger as prices rise. In a downtrend, volume should increase as prices fall. If you start to see prices rising but on really weak volume, that's a reason to be a little cautious.
So here's the big question, right? Why are we, as CMT candidates in the 21st century, studying a theory that was developed in the 19th? Well, the answer is pretty simple. Its core principles are absolutely timeless.
Let that sink in for a second. Almost every modern indicator that you're going to study, from things like market breadth to momentum oscillators like RSI or MACD, they are all essentially tools for confirmation. This basic idea that price action needs to be validated by something else, it all started right here with Charles Dow.
So as you continue studying for your CMT exam, I want you to keep this question in the back of your mind. Dow gave us the first real compass for navigating the markets. So think about how the core principles we just talked about today, confirmation, trend, and volume, are really embedded in the DNA of all the modern tools you use every single day. Because understanding that foundation is what separates a good technician from a great one.